Wall Street bulls are charging with more ferocity than they've had in years. The US stock market has been hitting a string of record highs during President Donald Trump's first year in office. It ended 2017 with the Dow Jones Industrial Average rising above 26,000. Over the course of the year, the blue chip index rose 25%. The broader S&P 500 gained almost 20%, while the tech-heavy Nasdaq soared more than 28%. Those gains were the strongest yearly performance for the indices since 2013. Analysts say the rally was fueled by optimism over Trump's tax overhaul. After months of political wrangling, the $1.5 trillion tax plan was signed into law in December. Trump says it will be a big boost to the US economy.
The tax cuts are the most significant tax cut, most significant reform in American history, with tremendous tax relief for working families, for small businesses, for big businesses that produce jobs, for just about everybody. Tremendous numbers, and you're already seeing what's happening.
The centerpiece of the tax plan slashes the corporate tax rate from 35% to 21%. After its enactment, companies like Wells Fargo and Walmart wasted no time in announcing pay raises and upbeat earnings outlooks. Trump sold the tax plan as part of his America First policy. It puts pressure on the country's biggest companies to build their factories and create jobs at home. The US economy added more than 2 million jobs during Trump's first year in office. It falls short of the figure Barack Obama delivered in his final year, but signals the continuation of a positive trend. The unemployment rate is at its lowest in 17 years and is poised to decline further. Growth is also picking up. The economy expanded at its fastest pace in more than 2 years in the third quarter of 2017. But critics say Trump is taking credit for a resurgence that was bound to happen.
So what we can think is the market going to continue looking more at the global economy, which is doing fine, looking more at the 9 years of expansion in the US, which is very good. And then if something bad happened to Trump, the market going to be happy. And if something good happened to Trump, the market going to be happy, because he's not the driver, I would say.
Some analysts say the weaker dollar is behind the market rally. It fell nearly 10% last year, making export-dependent companies listed on the S&P 500 more competitive. Whether you love him or hate him, Trump is in office at a time when the US economy is going full speed ahead. Laila Humairah, TRT World.
So let's go to our guests. Joining me from Paris is our editor-at-large, Craig Copetas. But first, let's go to New York and speak to David Levine. He's the head and founder of investment firm Odin River. David, I want to start with you. Welcome to the show. More than 100 companies in the US have said they're increasing pay or giving bonuses to their workers. Critics of the Trump plan had said that it would mostly be the owners of companies that would be benefiting. Are we actually seeing the trickle-down working?
Well, it's a little too early to say. I think that, as was mentioned in the opening remarks, the momentum that's been occurring in the U.S. economy has been occurring for quite some time. And, the benefits that we saw in terms of raises, in terms of, certain year-end bonuses, are the type of thing you would expect in a strong economy. So I think it's a little early to say that that's driven by the tax effects. Clearly, though, it definitely gave companies a reason to announce things in a way that maybe, allowed them to compliment the president. And so politically, I'm sure that it didn't hurt to have the announcement at the end of the year.
OK, so looking at it from an investor's point of view, do you think that the rally that we've seen has priced in the tax increases that were announced, or are we only just starting to see their effects coming into the stock market?
Well, if you look at the rally, it's been going on since 2009. On pretty much any metric, we're at all-time highs, whether it's a Shiller-adjusted PE, absolute PE, EBITDA to, valuation multiples of any kind, whether enterprise to EBITDA, et cetera. And as a result, I'd say that, there's a lot of things that are priced in. The tax cuts, of course, must have been quote unquote priced in, but fundamentals seem to have ceased mattering a while ago. So I'd say that from my perspective, that, the tax effects, whatever they might be, have been priced in for some time.
Nonetheless, we've seen a very sharp rise from, I'm just looking on the S&P 500, going from 25 all the way to 26 in about a month. Are you worried about the speed of that increase?
Well, what happens in a market where fundamentals don't matter, you mentioned previously on your program Bitcoin, whenever you're in a market where things are being driven by momentum, it's really hard to know when they'll stop, and it's also really hard to quantify, the downside of when things will kind of reverse. And so in this case, I'm sure that the tax effect increased the momentum. It added more reasons for people to buy. But again, for a long time, I don't think people have been buying based on fundamentals. So the risk is clearly evident across markets, not just U.S. equities, in my opinion. But I think that this rise is just added to that risk.
Right. Craig, let me turn to you. What's your reaction to David's comment there that there's still a lot of risk out there, isn't there?
Well, what you have is a market populated by people who waver between enthusiasm for Trump's economic policies and indignation against the man himself. I think David's absolutely correct that whatever benefits of the tax cuts, we're not going to see those until the third quarter, I would suspect, at the earliest. I think what you have to worry about here, because everyone gets worried when things start going really well, there's this kind of action in economics called a market melt-up, which is opposed to a market meltdown. A market melt-up happens when you got so many people stampeding in to buy stocks that there's no way to figure out what's going to happen, and it's actually going to kind of like throw a big bomb in the whole pool and everything's going to collapse. I think that is really the only concern right now, because this market is just going helter-skelter, as David said, on every metric that you look at. I mean, my favorite metric is the Drain the Swamp Index. Have you ever heard of that one, Azar?
That's a new one on me.
The Drain the it's actually. Yeah, no, it's actually an index. It's been around for a year. It includes all these companies that Trump doesn't like: the New York Times, Goldman Sachs, Exxon, Amazon. It goes on and on. The Drain the Swamp Index is up 19.5%. So show me an index that's down. I don't think it exists, and people want in on the action and are willing to overlook Trump's other failures or overpromises to make some money.
It sounds a little bit like the fake news awards to me. David, I saw you shaking your head to what Craig was saying there. You're in disagreement with that, I take it.
No, well, I just think it's absurd. I think that the only index I can think of that's down is the short Bitcoin index. I mean, it's truly, we're at an absurd time in the markets where it's really, it doesn't show any signs of stopping. I'm really staggered. Just when you don't think it can go higher, it does.
I mean, another way of talking about melt-up, really, is to look at it in terms of greed and fear, the good old-fashioned way, really. I mean, isn't it? David, are we basically in that latter stage of rallies where you get that explosive surge as retail investors flood in, thinking that they've missed out, and we're still being driven by greed? And at a certain point, that's going to turn to fear, isn't it?
Of course. I mean, I think that the momentum that's behind this and the fear of missing out, you mentioned Bitcoin. I use it just as an example. It's one of many asset classes. The U.S. equity market is reflecting something similar that's happening in the credit market. It's happening globally. And so, sure, I think that the individual retail investor in South Korea that's plowing into Bitcoin is not too dissimilar from the institutional investor in New York who's plowing into the S&P 500, or the institutional investor in Europe who's buying European high yield at yields that are lower than U.S. Treasuries. I mean, it's, from my perspective, we've been in a pretty absurd market for a while, and yes, it does seem like it's getting into the latter stages. When it will stop, I don't know. And when you're not buying things on fundamentals, it's really hard to stop. Yeah.
It's going to take a very brave person to predict this market as well. David Levine of Odin River in New York and Craig Copetas in Paris, thank you both very much indeed.